Hello, good day. In my last few videos on corporate finance, our focus has been on merger and acquisitions in which companies pursue their corporate objectives and business strategies. In this video, we now turn to the opposite of acquisition, the divestiture phenomenon, in which a company sells a part of its business, say a division, or rearranges the ownership of some of its businesses. This need may arise because a division of the company is performing poorly or simply because it no longer fits into the firm's plans. In recent years, many companies have moved away from managing a complex, diverse set of businesses to a coherent business portfolio more easily understood by investors. Most businesses, particularly large, highly diversified organizations, are constantly looking for ways in which they can enhance shareholder value by changing the composition of their assets, liabilities, equity, and operations. At the end of this learning session, it is hoped that students would be able to understand the different forms of divestiture, their rationale, process, and implications. Stay tuned and let's learn together. What is a divestment or divestiture? A divestment is the opposite of an investment or acquisition. It is the sale of part of a company, for example, assets, product lines, divisions, brands to a third party. Divestment is used as a means of restructuring. It reflects the efforts of the corporate management to adjust to changing economic and political environments. One of the motives for acquisition is the managerial belief that the two businesses are worth more when combined than separate. The arithmetic of synergy from acquisitions means that 1 plus 1 is equal to 3. A form of reverse synergy is a major reason for divestment. The two elements of an existing business are worth more separated than combined. The arithmetic behind divestment or reverse synergy argues that 3 minus 1 can be worth more than 2. In other words, part of the business can be sold off at a greater value than its current worth to the company. In the context of divestitures, there are a number of factors that motivate divestitures. First, the divested division is underperforming in relation to its industry competitors or to other divested business. Second, the divested part has a poor fit with new strategy. The parent wants to concentrate on areas with the greatest competitive strengths. This process is known as sticking to the knitting. Third, the parent is too widely diversified, causing difficulties in monitoring the performance of divisional managers. Fourth, the parent is experiencing financial distress and needs to raise cash to mitigate this and avoid eventual liquidation. What is diversification discount? Diversification discount is a concept that is used to describe the disadvantages arise from merger and acquisition. If AB is worth less than A plus B, this is known as the diversification discount. What are the causes of diversification discount? It may occur due to the following interrelated factors. First, management difficulties make it hard to create value in diversified businesses. Second, the market values focus. And third, the market finds it hard to value diversified companies. Divestiture can be classified into four major types. We shall learn more in the next few slides. Stay tuned. Sell-off means the sale of assets or a business unit to another company for cash. The simplest way to divest an asset is to sell it. For example, selling off an old factory or warehouse. But sometimes the whole business division is sold. Asset sales are a way of getting rid of poor fits. Spin-off means the parent company turns a business unit into a separate company and gives its shares to the parent shareholders. A spin-off is a new, independent company created by detaching part of a parent company's assets and operations. In equity carve-outs, the parent company turns a business unit into a separate company and sells its shares to the public, potentially retaining some ownership. How different is an equity carve-out as compared to spin-off? Well, equity carve-out is similar to spin-off, except that shares in the new company are not given to existing shareholders, but are sold in a public offering. In a buyout, a company or a business unit is taken private. Its shares are held by a leveraged private holding company which is created using private equity. We are going to learn more about the different types of buyout in the next few slides. What are the major considerations behind the choice between sell-offs and spin-off? If you are a finance manager, which choice would you select? Let's survey the literature. First, researchers found that if cash needs is important to the company, sell-off is a better choice. Second, riskier assets are more likely to be divested in a spin-off than a sell-off. This is because the risk of the asset can be spread to external shareholders. And lastly, an overvalued firm tends to sell off rather than spin off. Researchers also found that announcement of both types of divestment lead to significantly positive cumulative annual returns, but the effect is larger with spin-offs. When would equity carve-outs be popular over other methods? First, companies that need cash are more likely to carve out rather than spin off. Second, carve out also depends on stock market conditions. When the equity carve out market is hot, this method is chosen over asset sales. Third, product market conditions. When companies need to make relationship-specific investments, carve-outs are more likely than spin-offs. Spin-offs are more likely in larger industries, those with positive demand shocks. The buyout form may vary in terms of the role of management. What are the key differences between management buyout and management buy-in? Read the following statements. I'm going to ask you a question. When the buyer is an external party, do you classify the buyout as MBO or MBI? I'm sure you know the answer. The answer is MBI. Let's learn more about management buyout. Why is MBO appealing to professional managers? Why do large corporations pursue MBO? How is MBO financed? Next, we are going to learn more about management buy-in. Why do outsiders engage in MBI? What are the reasons for MBI? I'm sure you can derive the answer from what is leverage buyout? According to the definition of Sudha Sanam, leverage buyout is an acquisition of a corporation as a whole or a division of a corporation, mostly with cash. The cash being raised with a preponderance of debt raised by the acquirer. In another word, LBO finances an acquisitions with a small amount of equity and a preponderance of debt. The aim of leverage buyout is to leverage the returns to equity investment with substantial debt. With small base in equity financing, astronomical returns can be earned over very short periods of 1 or 2 years. Who are the leverage buyout acquirers? There are three types of acquirers. There are certain characteristics that lenders look for in a prospective leverage buyout candidate. First and foremost, the target company must produce good cash flows, with a view to service the debt borrowed for the acquisition and in order to ensure the smooth ongoing operations of the firm, the existence of sufficient, strong and secure cash flow is considered indispensable for a successful leverage buyout program. On the other hand, the target company may be poorly managed, but it is fine. This is because the new management will implement changes, new strategy to turn around the target company. There are four distinct but related stages in the buyout process. The first stage involves identifying the target. In the second stage, a holding company is created to hold the target as an asset. Arrangement of financing happens during this stage. The target company is taken private. In the third stage, the target company is reorganized. A new management, with or without existing management, is formed to enhance strategy and operation. The final stage is known as exit stage. After the restructured company emerges stronger and the goals set by the leverage buyout investors have already been achieved, the investor may take the company to public again. This process is also known as reverse leverage buyout. In a leverage buyout transaction, The majority of a company's capitalization is debt financed. There are a number of types of financing which can be used in a leveraged buyout. Senior debt is ranked ahead of all other debts and equity capital. Senior debt is usually secure on specific assets. It has the lowest cost of debt. Subordinated debt or junior debt is ranked behind senior debt in order of priority on any liquidation. Since subordinated debt gives the lender less security than senior debt, lending costs are typically higher. Mezzanine debt is usually high-risk debt instrument provided by specialist funds. Lastly, equity is the riskiest part of an leveraged buyout capital structure. However, ordinary shareholders will enjoy the upside return if the company is successful. This slide shows an example of the structure of a leveraged buyout. SMCP is a French apparel retailer. KKR is a private equity firm. KKR and the management team purchased SMCP through leveraged buyout in year 2013. KKR became the majority shareholder that owns 64% of the holding company, while the management owns the balance 36%. The holding company is heavily financed with debt. The debt-to-asset ratio of the holding company is 67%. Exit is the process of realization of the investments made in a leveraged buyout. Leveraged buyout investments by sponsors generally have a built-in program of liquidation and exit. According to Sudha Sanam, the majority of leveraged buyouts, approximately 57%, are exited within 5 years. What are the exit options for leveraged buyout? There are three ways. First, trade sale to a strategic buyer, for example, corporate in the same line of business that can reap scale or scope economies or leverage marketing capabilities. Second, taking the company public through IPO to public equity investors. And third, sale to another financial buyer through a secondary leveraged buyout. According to statistics from BVCA in 2018, trade sale is the most popular exit strategy for leveraged buyouts. How does the leveraged buyout structure encourage change? First, the use of debt financing provides texture and monitoring effort to improve cash flow to meet debt repayments. Second, the change in management following leveraged buyouts, especially managerial ownership, can provide incentive for improvement. Third, being a private company, the management faces no market pressure, less agency problems, and different governance structure. We shall discuss further on the governance structure of leveraged buyouts. A company that has undergone leveraged buyouts has smaller boards than listed companies. Independent directors are rewarded using equity and spend more time on the business. The improvement in governance leads to better corporate performance. Finally, we have come to the end of this video. I have the vision of making my educational videos open to the public after the COVID-19 pandemic lockdown to encourage sharing of academic knowledge. If you like this video and find this video beneficial for others learning, please click like or share. I welcome you to subscribe to my YouTube channel too. See you and goodbye.